Kelsey, Berro, JP Morgan, asset management, portfolio manager. I'm not going to bury the lead. You think July was it? Won't be anymore.
That is our belief. Yeah, we think that they will skip in September, and as the data comes through, it will be clear that they've done enough.
The lagging effect will become evident by the next meeting.
It will become evident. We think it already is evident.
If you look closely enough, and we're going to go into some of the details you look at. Have you guys ever thought about how lucky we are? We have ready-made news. I mean, the general news are like sitting around, God, is there going to be anything happen? You know, what are we going to talk about? There's a CPI, there's data. And next week, there's all kinds of stuff coming that's going to give us an idea of what's going on. And we're going to be there to report on it.
Absolutely. So CPI and retail sales are the two big data points next week that we think the Fed is going to be paying attention to. Retail sales, to me, is a really interesting one because we have seen a lot of strength in the consumer in June and July. You're hearing everyone talk about the Taylor Swift effect, the Beyonce effect, the Barbie effect, the Oppenheimer effect. But what I look at, though, when I see that retail sales data is I see a consumer that's spending beyond their means. Excess savings is being depleted, the savings rate is falling, and credit card balances of consumers are rising, as well as interest expense that they need to pay on those credit card balances is rising.
Have we spent down the COVID excess funds that we've had to this point?
We estimate that we will by Q4. But based on the most recent data we got in July, that's actually happening faster. So what I see is a pull forward of consumption, a really fun summer. I hope you guys had a fun summer. I had a fun summer. But now we're returning to the real world in the fall. Student loan payments are restarting. And as it relates to the Fed, just tying it back here, what we expect is that there is some downside risk to the retail sales report next week. And we're going to see that the consumer had fun over the summer, but ultimately we think that growth and inflation are going to continue to moderate as we go through the second half of the year.
Even though oil's at 86, we're going to talk to Dan Yergin later, but you continue to think that shelter costs and the supply chain easing will drive the number. And then even in the core, they back out energy anyway. But people worry it'll seep into other things. But you think it continues to trend lower?
We do think that the trend lower in core inflation will continue. There are some categories where energy does flow through into core, kind of seeps in. One of the most obvious examples is airfare. So airfare is actually considered a service in CPI, and so jet fuel is obviously going to be a big contributor to prices. But the biggest component within inflation is shelter costs. And one of the indices that I've been watching, and this is pretty consistent across most of the private data that we've been looking at, but this one is the Cleveland Fed puts together a new tenant repeat rent index. It's down. It's negative year over year for the first time since 2010. That didn't even turn negative during COVID. So what I'm saying here is there is quite a lot of disinflation still in the pipeline. Last year, it was about goods inflation coming down. You had goods inflation running at 12%. Now it's down to 1%. The next leg of the disinflation trade that will happen is going to come from shelter. And again, that's going to allow the Fed to be able to pause and be able to keep the Fed funds rate on hold through the rest of the year.